Everybody. Thank you for joining me. And this is a fun week here in Hong Kong. It is the Lunar New Year celebration. So tomorrow, which is Tuesday, Wednesday, Thursday, these are public holidays. And today, Monday, which is actually still Sunday in the U.S., Monday it'll be U.S. President's Day, U.S. holiday. So it's kind of a funny week in terms of days off and where exactly is the team working this week. But we're working somewhere, and I'm working here in Hong Kong today. I wanted to share a couple of interesting charts. As you know, we publish a lot of different research highlights that drive our decision making for our portfolios, and we may be a little overly obsessed over this topic and subject matter, but you know what? It's good to be a little obsessed, especially nowadays, given all of the uncertainty. And certainly we see some very interesting things in data. And so with that, I want to share my screen with you so you can see. So in this particular chart, inflation buoys retail sales and credit card debt. And this is just updated through the end of last month. It really peeves me every time I hear, oh, retail sales are up in the US. Well, yeah, retail sales are up because everything's gotten more expensive. It isn't necessarily because people are just deciding to spend more or have more discretionary spending. That may be a little bit of the component from a couple of years ago, but today, and as you see these lines converging, in this fuchsia line, you see U.S. retail sales, a monthly figure. So every month, U.S. consumers spending a lot of money. And I like to look at this figure in actual dollar terms and not a month over month or year over year percentage change. I just want to look at the raw data. And so all three of these are actually raw data. We're not looking at changes or percentage changes over some period of time. We're looking at the actual data itself. And then you compare that to the shaded area of looking at US credit card debt, and you can see that's amounted to about $1.3 trillion worth of debt. And then you see the consumer price index, which is at 326.59. So again, this is looking at the index. I bet a lot of you that are actually watching this right now have never seen the actual index figure. You will always hear about the inflation rate, which is 3% or 4% or 2.8% or some percentage figure, but that percentage figure is derived based off of typically a year-over-year change or a 1 month change that has been annualized. But you don't actually ever see this underlying index figure, which drives those percentage figure changes relationally to various other points on this chart. So you look at this and it looks kind of extraordinary because they all trend upwards. So sure, retail sales have looked really, really robust over the past 5 years, but so has the accumulation of credit card debt. And so has the increase of the price of things. And so ultimately what this chart is really indicating, certainly to us from an outlook standpoint, is that consumers have really been relying upon their credit cards just to keep up with their living. They've been using it because prices have gotten more expensive, and so they're not making necessarily a lot more money. In fact, many instances they're losing work, and so they're relying on their credit cards to be a source of that maintenance of consumption. So this is a very, very important chart, and I don't know why this isn't given more attention in the news media, because ultimately, if you net out the impact of inflation from retail sales, you're not really seeing something that is extraordinary. You're seeing something that is uh, holding on to par at best, maybe even a little below par over the past few years. Inflation has really played a very, very big role in the strength of the retail sales figures. That, and separate and apart from that, and I don't have a chart to show it, but people talk a lot about the K-shaped economy and how the top 10% of income earners are actually responsible for more than 50%, more than 50% of all of the domestic consumption in the U.S. So you have the top 10% of income earners that are really buying everything, and they're not necessarily adding to the credit card debt situation. But then that bottom 90% is in fact adding to that credit card balance increase. And of course, delinquency rates are also hitting all-time record highs of recent years as well. So please be aware of this. Please understand this. This certainly is something that we're very, very concerned about for the U.S. economy, which is one of the reasons why we have actually right now a net underweight, of absolute net underweight to U.S. Stocks, in particular the large cap and mega large cap segment of the U.S. stock market. And we've had that in place for a little while now. And we're very happy to have that type of positioning, given this as a backdrop. And now the second slide I'd like to share with you is something dealing with housing in the United States, looking at not only the 30-year mortgage rate, but also existing home sales, new single-family home sales, and then, of course, the infamous effective Fed funds rate, the federal funds rate, which everybody talks about. Oh, the Fed funds rate is coming down. Let's get it down lower. Let's get it down lower. Well, I've written about this many times, but the Fed funds rate going lower doesn't necessarily mean you're going to see huge drops in market-based yields, whether that be high-yield bonds or corporate debt or sovereign debt of nations, or in this instance, mortgage debt. Maybe a little bit of a tracking there, but ultimately market-based yields are not being determined by the Fed funds rate. I think this is a big misunderstanding and misconception in the marketplace. So you look and see that, just a few years ago, the amount of existing home sales when the Fed funds rate was very, very low and that mortgage rate was very, very low in that 2% range. And tons of existing home sales and new home sales were being sold hand over fist. That's this area all the way on the left-hand side where you see just lots of sales activity. It's great. Lots of units being moved. And then, of course, the rate hike cycle began, and you saw this big, big drop off in new housing. And then existing home sales followed suit. Now, existing home sales have continued to be very, very lackluster, very few transactions that are actually occurring in the marketplace. And certainly that has persisted because of this increased, persistent high level of mortgage rates. But what you do notice here is that new single family homes have kind of stayed in this, kind of oscillated in this, I would say a little bit better range, stronger range. Looks like it rebounded a bit. But what is very, I would say, obscured by this chart and not articulated by this chart is the fact that the new home builders have been absorbing the impact of higher mortgage rates. And so they'll offer more favorable rates to the buyers without having to adjust the price down significantly because they'll just finance it. So they're going to eat that cost. So ultimately, they're eating the cost on the financing side. They're not eating the cost on the selling of the property value side. So this creates a market distortion. This is a market distortion type event. And something also that I think doesn't feed, it doesn't really feed through to the business media the way that the way that I think it should, which is that there's something very, very dynamic that's happening in the real estate market in the US. And it's such an important market because of the wealth effect. People feel more bold to spend when they feel that their home values are much higher. And because there's been so few transactions happening in the marketplace, the current confidence that a homeowner can have on the value of their property is actually quite limited because there are not robust numbers of transactions occurring in the marketplace. And on top of that, there is this marketplace distortion that the developers, the new home developers, have created based on their subsidy, basically, of financing costs. So those are the two charts for today that I wanted to share with you. And of course, if you have any questions or want to dive deeper, you can contact us at info@Align Wealth LLC. That's for our US viewers, and or inquiry with an E, inquiry at awaim.hk for those that are based in Asia, Hong Kong specifically. And we're always happy to engage in this discussion and conversation more deeply with you. And in the meantime, have a very happy holiday weekend in the US, and also a very happy Lunar New Year for all of our friends here in China and Hong Kong. Take care. Bye-bye.